It's good to see you. I mean, you've been, in the camp sticking to the idea that this market is in an uptrend since October. It's gotten a little ragged. Parts of the market have, on the verge of breaking down. But what's your assessment right now of this push to a new, 9-month high?
Yeah, look, I'm still optimistic. I think there are better things happening than people, or particularly the bears, are giving it credit for. One of the big ones for us, our credit spreads have really kind of led the way here. They've stalled out a little bit, but certainly not anything like you'd expect given the concerns around banking and some of these concerns around recession. And I think that's kind of the bears' biggest foil here is it's hard to explain what's happening to the credit markets. They've been very, very resilient, and usually the equity markets are going to be an offshoot to that. And I think that's exactly what you're seeing. So, this is one of the more interesting markets that I can remember in the 33 years I've been doing this, where, you've got different industry groups within sectors, or even different stocks within the same industry that look completely different. And I'll just give you one example, the difference between Uber and Lyft, which last I checked, they're both in the ride sharing business. I know there are a few more bells and whistles to the different companies, but those are completely different charts. And we see that in every single sector, that you can really draw a distinction to very good charts in one industry group, but within the same sector, some very bearish charts as well. So that's been the challenge. It certainly has been a stock picker's market.
Well, yes, absolutely. And that theme of, haves versus have-nots, the market seems not to be able to be sort of broadly inclusive. At least it hasn't been for now. And that's been a big criticism, right? Oh, it's just a few stocks. The real market is actually not doing a whole lot. But today we see some catch-up move. Is there the possibility of the market essentially repairing itself internally by rotating?
It's a much higher probability than people give it credit for. And I know people are using this breadth as a crutch, and the breadth has not been as robust as you'd want it to be, but it certainly hasn't been, exclusively bearish as well. And I think that's important. When we go back and look at the points where you've had divergences, just using trends, 68% of the time, let's just call it 2/3 of the time, breadth catches up with price, not the other way around. Now, breadth has made some very good calls. It made a good call at the beginning of 2022. It was a divergence that led to a bear market at the end of 2007. And then the same thing at the end of 1999. Breadth was weaker than the market. And obviously, we had bear markets in each of those three.
Yeah.
But you've had a host of other points in time where the S&P's been trending and breadth has not been trending. And what ended up happening was, instead of the S&P succumbing to the breadth line, again, 2/3 of the time, started to repair and improve itself back to the market averages. So I think that's just another, I think it's been too widely used of an excuse. And there was this focus on quality, particularly around the debt ceiling and the banking crisis. And now, as that kind of dissipates a bit, people are willing to step out on the risk spectrum. And you're seeing it in beta. You're seeing it in the decrease in high quality names in terms of performance. And that tends to be good news, not bad news.